$67.50. Take a second and let that number sink in. As we sit here in the closing days of December 2025, the silver market isn't just rallying, it is undergoing a structural transformation that we will be talking about for decades. For the first time in history, the devil's metal has shattered its nominal all-time highs, leaving the psychological $50 ceiling in the rearview mirror. It didn't just tiptoe past 50. It blew the doors off the hinges, surging 130% since the start of the year. If you feel that tightness in your chest, that mix of excitement and did I miss it? You aren't alone. The velocity of this move is historic. Silver is currently outperforming gold, outperforming the S&P 500 and leaving every other major commodity in the dust. But here's the thing. The real story isn't the price on the screen. The real story is the absolute scramble for physical metal happening behind the scenes, a scramble that has turned the global silver market into a high-stakes game of musical chairs, and the music just stopped. Think about where we've been. History has a way of rhyming, but this time the rhythm is different. We all remember the stories of 1980, the Hunt brothers and their attempt to corner the market, which sent silver to $50 before the regulators stepped in. Then there was 2011, the era of massive quantitative easing, where silver again touched that $50 mark, only to be rejected. For 45 years, $50 was the great wall of the silver market. It was a ceiling built of speculation and paper contracts. But today, in late 2025, $50 hasn't just been broken. It has been converted into a foundational floor for a new era of price discovery. In the past, those rallies were driven by fear or greed alone. This rally, it's being driven by need. We are witnessing a collision between monetary debasement and a literal physical scarcity that the world has never seen before. This isn't just another speculative bubble. It means to say structural repricing of a critical strategic asset that the modern world cannot function without. Let's look at the cold, hard data, because the numbers don't lie. As of right now, we are wrapping up our 5th consecutive year of silver supply deficits. Let that breathe for a moment. 5 years of the world consuming more silver than it produces. Since 2021, the cumulative deficit has surpassed 800 million ounces. To put that in perspective, that is roughly equivalent to an entire year of global mine production. Just gone? Vanished from the vaults. And where did it go? It didn't go to speculators in New York. It went into the silver paste used in 232 million ounces worth of solar panels this year alone. It went into the high-performance connectors of AI data centers and 5G infrastructure, where silver's unmatched conductivity makes it irreplaceable. It went into the battery management systems of millions of electric vehicles, each requiring 25 to 50 grams of the metal. This demand is sticky. It's rigid. A solar farm does not stop needing silver just because the price went from $20 to $60. They have to have it, period. But here's where the math gets truly terrifying for the shorts. While demand is exploding, mine supply is stagnant, paralyzed at about 813 million ounces a year. Why? Because you can't just build a silver mine. Nearly 80% of silver is produced as a byproduct of mining for copper, lead, and zinc. Even with silver at $67 an ounce, a copper miner isn't going to double their production if the copper market is soft. Silver supply is price inelastic. We are stuck with what we have. And what we have isn't enough. The buffer stocks held in the London and New York vaults have been decimated, with COMEX registered stocks down roughly 70% from their 2020 peaks. We saw the fragility of the system during the Thanksgiving squeeze last month. A simple cooling system failure at a data center disrupted electronic trading. And for a moment, the world had to look at physical hubs in London and Shanghai for a price. In that moment, spot prices disconnected from paper, and industrial buyers scrambled to secure metal at any price. It was a warning shot. The paper market's ability to suppress the price through derivatives is failing because you can't build a solar panel out of a futures contract. If you want to know how desperate the situation is, look at the backwardation. In a normal, healthy market, silver for delivery next year should cost more than silver for delivery today to account for storage and interest. But right now, the spot price is higher than the futures price. At one point recently, physical spot silver was trading nearly $2 above the December futures contract. This is a flashing red light on the dashboard. It means industrial users and refiners are so desperate for metal, they are willing to pay a massive premium to get it now rather than wait. They are effectively saying, I don't care about next month, I need the bars today. This is corroborated by silver lease rates, the interest rate paid to borrow physical silver, which spiked to nearly 100% in October and is still hovering near 70%. Bullion banks are refusing to lend their metal because they're terrified they won't get it back, or they need it to cover their own delivery obligations. This liquidity crunch in the wholesale market is often the precursor to explosive vertical price moves. Now, let's talk about you, the investor. You're looking at $67 and wondering if you're too late. The technicals tell a story of extreme momentum, but also a need for caution. Silver is currently trading well above its 50-day and 200-day moving averages, and the relative strength index, the RSI, is reading between 69 and 76. In any other market, that would be screamingly overbought. But in a supercycle breakout, assets can stay embedded overbought for months as the big money finally wakes up. We have major resistance sitting at the $68 mark, and after that, the next big round number is $70. If we break 70, the Fibonacci projections suggest a medium-term target of over $81. On the downside, the 100-hour simple moving average has been providing a floor at $64.75. As long as we hold 60, the supercycle thesis is alive and well. But we have to talk about the trap. If you are a stacker, someone who buys physical bullion for the long haul, you need to be very careful right now about premiums. In the retail market, especially in North America, there's a massive dislocation. American Silver Eagles, the government-issued coins, are currently carrying premiums as high as 35%. With silver at $67, you might be paying $85 or $90 for a single coin. And listen to me, that is mathematically inefficient. You are paying a 30% FOMO tax just for the privilege of owning a specific brand. For the pure investor, this is a hurdle rate that is hard to clear. To even break even, the spot price has to rise to $87. Smart money right now is focusing on weight. Look at 10-ounce or 100-ounce generic bars, or 1-ounce generic rounds. The silver is the same, but the cost of acquisition is significantly lower. Don't let the retail frenzy cloud your judgment. Focus on the most ounces for your currency. And then there is the gold to silver ratio, the GSR. This is the ultimate barometer for value. As of today, the ratio is sitting at 65 to 1. This means it takes 65 ounces of silver to buy 1 ounce of gold. Historically, in the 20th century, that average was closer to 47 to 1. In the 2011 bull market, it dropped to 30 to 1. The fact that the ratio has fallen from nearly 90 earlier this year tells us that silver is outperforming gold, which is exactly what happens in a risk-on precious metal cycle. But at 65, we are still in a neutral zone. If you're a long-term holder, this isn't the time to sell your silver for gold yet. The math suggests you should wait. We are watching for the swap zone, that level below 50 to 1. If the ratio hits 50, which would mean $87 silver if gold stays flat, that is when you begin to rotate. You trade your volatile silver for the stability of gold, locking in your alpha and reducing your portfolio risk. If you prefer the equity markets, you've likely noticed a strange disconnect. And while silver is up over 120%, the mining stocks have been lagging the metal's performance. This is a catch-up trade waiting to happen. Historically, miners act as a leveraged play, but in 2025, they've been fighting input cost inflation for diesel and labor. However, specific companies like Hecla Mining are already up nearly 300% year to date. The junior miners, through ETFs like Acai LJ, are up over 150%, outperforming the senior miners. Why? Because in a mania phase, liquidity flows down the risk curve. If silver consolidates above $60, the fourth quarter earnings for these companies are going to be astronomical. The market hasn't fully priced in $67 silver into the miners' balance sheets yet. For a trader, that is an opportunity. So, what is the move? If you're a stacker, hold fast. The structural deficit is nowhere near being resolved, and the industrial demand from solar and AI is only accelerating. But stop buying the expensive government coins. Switch to low premium bars and focus on your total ounce count. And most importantly, reevaluate your security. At $70 an ounce, a single monster box of 500 ounces is worth $35,000. Check your safe ratings, check your insurance, and consider professional vaulted storage for a portion of your holdings. If you're a trader, don't chase this vertical move at $67.50. Wait for the retest of the $64 to $65 support zone. Use tight trailing stops, because silver corrections can be brutal, sometimes dropping 10% in 48 hours. Looking ahead to 2026, the experts are split, but the bias is heavily to the upside. In our bull case, where the industrial deficit worsens and the Fed cuts rates to save a softening labor market, we could see silver breach $100 by next year. In our base case, the price likely oscillates between $60 and $75, allowing the market to digest these massive gains. The only real threat is a broader stock market crash, a liquidity event where hedge funds are forced to sell their profitable silver positions to cover losses in tech stocks, similar to what we saw in March of 2020. But even then, any dip toward $50 would likely be met with massive physical buying from central banks and industrial users who have been waiting for an entry. The bottom line is this: the silver market in December 2025 is not a bubble. It is the realization of a decade-long structural thesis. The world finally figured out that silver is not just a precious metal. It is the indispensable glue of the modern technological age. The convergence of monetary disorder and industrial necessity has created a floor that didn't exist in 1980 or 2011. The easy money of the initial breakout is gone, but the smart money is just getting started. We are moving into a phase of extreme volatility as the world seeks equilibrium between a shrinking supply and a growing demand. Stay disciplined, manage your risk, and most importantly, watch the ratios. The devil's metal is finally awake, and it has a lot of catching up to do. The era of cheap silver is over. The question is, are you prepared for what comes next? At these price levels, the difference between a successful investor and a victim of the market comes down to one thing: strategy. Don't let FOMO drive your decisions at the top, and don't let fear shake you out at the bottom. We are in the middle of a once-in-a-generation supercycle. If you've been holding since $20, congratulations. If you're just starting, be patient and wait for the levels we discussed. The fundamentals are on your side, but the market will test your conviction with every 50-cent move. Stay focused on the long-term structural deficit and the rising importance of silver in the global economy. This isn't a sprint, it's a marathon through a minefield. Walk carefully. The Gray Ledger is here to help you navigate these shifting sands. We will be watching the $68 resistance and the GSR levels daily. If the ratio starts to compress toward 50, we will be the first to let you know. Until then, keep your eyes on the data and your metal in the vault. We want to hear from you. What is your personal price target for 2026? Are you a buyer at $67? Or are you waiting for the retest of 60? Drop your thoughts in the comments below. And if you want to stay ahead of the next move in the precious metals complex, make sure to subscribe and turn on notifications. The silver story is just beginning, and you don't want to miss the next chapter. Disclaimer: this content is for educational and informational purposes only and does not constitute financial advice. Precious metals and mining equities involve significant risk, and past performance is not indicative of future results. Always consult with a qualified financial advisor before making any investment decisions. Silver is highly volatile, and you should only invest capital that you are prepared to lose. Stay safe and stay informed.